housing market crash of 2022. It seems like it's every buyer's dream right now for that to happen so that prices will go down and homes will be more affordable. Well, I'm sorry to burst your bubble, but here's 3 reasons why you shouldn't care if we're in a bubble or not, and a couple bonus reasons why you're probably going to be disappointed with the outcome of the crash and why you won't actually buy when it does. Hey there, I'm Haydn Halsted of the Halsted Home Team here in Spokane, Washington, here to answer all your questions about housing, Spokane life, and anything you have questions about. If you have anything specific you would like to know, drop a comment below and I'll be sure to answer it in a follow-up video, or you can call, text, email me right here. Let's get into the video. All right, so the first reason why you shouldn't care if the market crashes is because of something called a fixed rate mortgage. Now in this video, I'll be speaking about my generation who watched our parents and family members struggle through the 2008 recession, and we are fearful that it'll happen again. So as your fellow millennial, I hope to provide you some comfort on why we don't have to fear that happening again. I don't know about you, but my parents definitely had no business buying their first home. They've told me that the banks barely verified their income, they had little credit, and not only did they qualify for a house that was $80,000 at the time, but they had to get another loan to cover the down payment on that house. Now the house worked out well for them in the long term because they held on to it, which you'll notice becomes a theme throughout this video, and they owed so little on it that the recession didn't impact them. So they were able to refinance a few times, make some upgrades to the house, and ultimately they sold it 20 years later for a solid profit. But the point I am trying to make is that one of the big issues with the time was adjustable rate mortgages. This means that the interest rate you get when you first buy the home can change throughout your ownership. This was a huge issue for people during the recession because as home prices dropped, interest rates increased and made many people who were losing their jobs struggle even more to make their payments on their homes because those payments kept going up. That's why we basically only do fixed rate mortgages now. The mortgage you lock in when you buy your home will not change over the life of the loan unless you refinance. This is great because you know if you can afford your mortgage today, it's pretty likely that you'll be able to afford your mortgage down the road, especially if you plan on getting pay increases over time. This is why it's important to keep your monthly payments less than a third of your income, so that in the event that you do lose your income, you most likely will have a buffer to continue making the payments. So if you're buying a home today and you can confidently say that you will be able to afford your mortgage payment forever, then there's really no reason to worry if the market drops because your payment is not going to change. The big fear most people run into is that they think they're gonna get stuck in their home and not be able to sell it. Here's 2 questions for you. Do you plan on staying in your home more than 5 years, and could you rent your home out and be able to cover the mortgage? If the answer is yes to both or one of those questions, you should buy a house. If you bought at the height of the market in 2007, you would have had to hold on to your home for 10 years before you could break even on it. That would suck. But I've talked to many people who chose to put a renter in their house and bought again when the prices were lower. The tenant paid down the mortgage for them, so once they did sell, everything that they made on it was pure profit because the tenant paid down the loan. You might not have made as much as you wanted to, but you could have still come out ahead by just holding onto the property and dealing with just one tenant over time. So why are prices going up so much? Now, I'm like you, and if you've bought a home in the last 6 months, you're pretty stoked about how much equity you've made in that short period of time. We as a society are getting used to making a lot of money from our investments and putting us, a lot of us in a gambling mentality. The 24% price increase is a lot and isn't normal. But are we dealing with a bubble or a supply and demand issue? Looking at 2007, our average sales price had hit an all-time high of $212,000, which sounds pretty nice when you say it. But today, our average sales price is nearly double, and we finished 2021 over $400,000. Now, the difference between these 2 times is in 2007, we had 6 months of inventory, and today we have 14 days of inventory. What does that mean? You take the number of active listings in any given month and divide it by the number of sold listings in that month. If the number is below 3, then we're in a seller's market, and some would say an extreme seller's market. So when I say we've hit an all-time low of 10 days of supply, it's an extreme supply and demand issue. In 2007, there was plenty of supply for everybody. There was no competition in the market to get these homes. People were just buying them because it was easy to get the money to do so. And when the banks went under, that caused everybody else to go under as well. So we're not experiencing the same issue that we had in 2007 and 2008, which would lead us to believe that we're not going to have the same catastrophic result. But let's just pretend that we do. What would happen if 2008 repeated itself in Spokane? Well, between 2007 and 2011, prices dropped a total of 22%, falling to $167,000 at the bottom. This 22.1% made a difference of $40,000 in a home's value over 4 years when prices were falling. That's right, folks, market shifts and drops take a long time to happen. Everyone is waiting for the market to crash, but when it was crashing, there was nobody that was able to predict that it would take 4 years to hit the bottom, and so you couldn't have timed the market. But that's besides the point. We said that the prices dropped 22% over 4 years, and that was a $40,000 drop in prices. Well, I see homes selling for $80,000 over asking price on a daily basis, so if we saw prices drop $40,000, none of us would blink an eye. That wouldn't even bring us back to 2020 averages of $322,000 when we were convinced we were in a bubble then and prices had to drop. But what if the prices dropped 22% from where they are today? Well, like we said earlier, we saw a price increase of 24% from 2020 to 2021. So if prices dropped exactly like they did in 2008, you would get your 2020 prices back. Let's include inflation in this metric to make it more realistic to what would potentially happen. Inflation between 2007 and 2021 has been 23%. So if we take 23% of our 22% and add it on top of each other, that brings us to a total of a 27% drop. If the market crashes by 27%, that wouldn't even push us back to our 2019 prices of $284,000. The big question I ask from most people when I talk to them about this is, what is an affordable price? What is the price we're waiting for? It seems like many people think the average home in Spokane should still be around $250,000, which would be amazing, but there's two issues. I'm willing to bet that there are tons of people in 2018 saying that prices were too high when they had increased nearly 12% that year. Secondly, prices would have to drop nearly 60% for us to get back to that price, which is nearly impossible. And if prices drop that much, then there's far bigger issues in the world than you buying your first home. So with all of that information, I hope you're starting to see that it's unlikely for us to experience a correction like we did in 2008. But before this video gets too long, I want to make one more quick point. Everyone says that they will buy when home prices drop, but that is statistically just not true, and I'm sorry, but most of us, unless we're a confident real estate investor, are not going to risk catching a falling knife. In 2011, when prices hit their low after the market crash, we saw the least amount of home sales in the past 30 years. This means that the majority of people were fearful in the market at the time and did not purchase a home. It goes almost another 4 to 5 years after 2011 to really pick back up on the number of homes sold and gain more confidence in the market. So with all that said, if you can lock in a mortgage payment that you can afford, you plan on staying in your home more than 5 years, and if worst comes to worst, you can rent out your home and at least cover the mortgage payment, then there's no reason to continue waiting to see a drastic drop in home prices, because none of us are really going to even notice it if it does happen. Hope this video was helpful. Drop a comment if you learned anything, and never hesitate to reach out. Have a great day, and I hope to talk to you soon.